Okay, so now we're going to be doing a class example on revenue recognition, specifically using the different components of revenue. Please, I'm going to write a big NB across the top here. This is done terribly in practice, done terribly by students who are lazy. So just remember, we've got the different components of revenue. Revenue from sale of goods, revenue from services rendered, and then the revenue from interest, dividends, and royalties. Okay, each of those, if you remember the last lecture, has its own recognition criteria which will dictate when to recognize this revenue. Okay, so let's do the example. So you're selling a motor vehicle for 100,000. Okay, remember CU's currency units, might be rand, might be dollars, might be euros. Okay, we are operating here in South Africa, we would use rands, so currency units. I said excluding VAT and sales tax. The sales contract includes a 3-year motor plan that covers all maintenance and services. Okay, we've got a second component here, please. The value of the motor plan, if sold separately, is estimated to be 30,000. Okay, assumes VAT, value-added tax of 14%. Okay, so motor vehicle sales price, the 100,000, will have a component for sale of goods and a component for services. Very important, we will recognize them at different points in time based on the recognition criteria. So let's have a look. What would you do at sales date for your revenue recognition journal? I think we've assumed that this is a cash sale, so we know we'll go debit bank for the full 100,000 times 1,14, including the value added tax. So that gives me 114,000. Let's deal with the VAT. The VAT's always going to be, or the sales tax will 99% of the time be based on the contract amount. So that will be the 100,000 times 14%. Okay, and that will give me 14,000. Now what I need you to understand is we're going to have two types of revenue. The first will be revenue from services rendered. Now let's assume that the revenue will be earned equally over the 3 years as services are provided. But on day one, on sales date, will there be any revenue from services? No, there won't, because we haven't provided any service on day one yet. So we'll have revenue. Okay, a lot of you will want to write revenue here. Okay, what I'm saying is that is incorrect. Okay, it will actually be deferred revenue or income received in advance, which is a financial position account. Just remember, when I write IRA, it means income received in advance. You could also write deferred revenue, I don't mind. Okay, but the most important thing is that is a financial position account, please. There's no P&L here yet. Now, do I do this first or the revenue from the sale of goods? I'll always do this first, right? I'll do revenue received in advance. We were told specifically that if the motor plan or in the service contract was sold separately, it would be sold for 30,000. So we'll recognize 30,000. The remaining balance will be revenue from sale of goods in P&L. Why? Because the 5 recognition criteria are met, aren't they? The risks and rewards are transferred. The day the buyer drives the vehicle off of the showroom or dealership floor, there is no continuing managerial involvement. So no continuing control. The future economic benefits, very probable. We've received the cash, right? So the future economic benefits are probable. Can you make a reliable estimate of the revenue? Yes, you can. Revenue estimate can be made reliably. What is that figure going to be? Let's quickly do it. It will be the 100,000 minus the services component that is deferred or received in advance, leaving me with 70,000. Okay. And along with that, we must also be able to make a cost of sales estimate. Okay. Just remember, with this, we will go debit cost of sales, credit inventory. I haven't given you enough detail to do that journal. but you will know exactly how much you purchased that stock or inventory of motor vehicles for. Okay, so there's our journal. Please, revenue from sale of goods will go to P&L. The revenue from services will go to income received in advance, which is a financial position account. Okay. But it's not going to stay in financial position forever, will it? Well, let's assume now, at the end of 1 year, okay, assuming a full 12-month period has gone past, and we assume that 1/3 of the services have gone past. Well, then what am I going to do? I will take my 30,000 that was income received in advance, and I will times it by 1/3 years. You would probably do this based on the actual number of services, but let's keep it simple. Well, then I will definitely go credit revenue after 12 months from services in P&L. 30,000 times 1/3 gave me 10,000. So I will credit revenue 10,000. Obviously, I need to make my income received in advance account smaller. That was a credit balance. So I had a credit for income received in advance of 30,000. I will now debit that account to make it smaller. So debit my deferred revenue or income received in advance, financial position, 10,000. Okay, that will make my income received in advance smaller, leaving me with a closing balance of 20,000. Okay, imperative, we've recognized the two different components of revenue, i.e. revenue from services versus sale of goods, separately, based on its own revenue recognition criteria. The revenue from sale of goods was recognized 100% on the transaction date, the date that we met all these recognition criteria. The revenue from services was deferred and recognized over the period of the services being provided. Hope that's helped. Please work through this and make sure you master this concept before you move on. Thank you.